how do we find properties? Once you've identified a market and you've built a team, like how exactly do you get deal flow coming in? And then how do you actually make an offer and how do you close a deal? So you can start feeling confident, so you can start taking one step at a time towards getting your first apartment building. My name is Stacy, and welcome to RMFI Academy, where we empower working professionals to achieve financial autonomy through multifamily real estate investing. So let's start with determining your investment strategy. So in the world of multifamily properties, there's really two primary strategies. The first is called stabilized, and the second is called value add. Everything begins with your goal. You have to begin with the end in mind. So is your goal cash flow? Is it equity? Or is it both? So if your primary goal is cash flow, you want to have month over month, that monthly income coming in, just recurring without you doing anything, you're going to be looking for a deal that is stabilized. So what does that mean, stabilized? When you're buying a stabilized property, you're buying a property that basically is already performing from day one. So you come in, you get the property under contract, you do your due diligence, you get your financing, you close, and now you have the property producing cash flow on day one. Now, why wouldn't everyone do that? Because cash flow is king, right? Well, in general, if you're buying something that's already perfectly performing and there's nothing that's required of you, the returns don't tend to be as high. But who is it perfect for? It's really perfect for the busy professional that doesn't have time to do all of the value add activities, but just really has money they need to put into play. So stabilized goes with cash flow. All right, let's talk about the other strategy. Value add. This is actually my favorite. So if your goal is to build equity and build cash flow, but it doesn't have to be day one, value add is ideal. So what happens in a value add deal is you're looking for an opportunity to go in and improve a property. So if you were looking at a 2 to 4 unit property, improving it would be rehabbing it. Well, when you get into multifamily, 5+ units, value add can be any level of thing that's going to impact the net operating income. So that could be rehabbing in order to be able to charge more rent, because if you have more rent, then you have a higher net operating income. But you can do things like finding other opportunities to increase income, like vending or pet fees or different amenities that you could charge for, or you can decrease certain expenses, or you could do a combination of both. Either way, anything that you do that drives that net operating income up is going to increase the value of the property by a massive multiple. And we'll go into that in another video on another day, because that math is straight up fun. All right, so after you have identified your goal and your strategy, the next step is to select your market. So there's 3 things you want to look at when you're selecting a market. The first thing is the population and the population trends. So what do I mean by that? So if you're looking at a market and you see that the population's been pretty steady or it's increasing, we like that. That's a yes. But why? Like, what difference does it make? So think about it from a supply and demand standpoint. If you are buying rental property, let's say you buy a 10 unit or a 20 unit property in a market and the population is going down, down, down each year, well, you still have the same number of units, but now there are fewer people who want to rent your units. So strictly from a supply and demand standpoint, you end up having more supply and less demand because there's less renters. So what do you think that's going to do? It's going to ultimately either increase your vacancy expense, which we hate. Vacancy expense is the absolute worst, or it's going to start driving your rents downward. It's going to put downward pressure on your rent. So you can't charge as much, which decreases your cash flow. So you always want to be looking at markets that have steady or growing populations. If you ever see the population declining year over year over year, you just want to stay away from that, because that's not a place you want to hold property long term. Right? The second thing you want to look for is job growth. And really, job growth, it's the same exact way of thinking as population growth. So as long as the job market is staying at least steady and ideally is growing, more and more jobs are coming, that's a market that you're interested in, potentially, right? There's one more thing we're going to talk about, but that's a good sign. Where the opposite, just like population growth, if you're having fewer and fewer jobs, that means there's fewer and fewer people who can pay rent. And realistically, if there's fewer and fewer jobs, those people are going to leave. So usually population growth and job growth tend to be on a similar trajectory. So those are the 2 things you want to look at when you're looking at holding anything long term. Now, the third thing, this thing is really, really, really important, and it's called the 1% rule. So the 1% rule basically says you want to be in a market where the prices and the rents align in a way that produces positive cash flow. So for example, Let's just say we're in San Diego, California, right? I lived there for a very long time. Well, in San Diego, properties are so expensive. I mean, rents are pretty high too, but rents aren't anywhere near as high as the prices. So for example, if it was going to meet the 1% rule, I would need to buy a property for $500,000 and be able to get $5,000 a month rent. Well, realistically, when I lived there just a few years ago, I could buy a single family home in a regular normal neighborhood for probably $650,000 to $700,000. Well, the rent was about $3,000. That was the market rent. So we have not met the 1% rule. If I have to buy a property for $700,000, I'm going to have $7,000 a month rent coming in for it to meet that 1% rule. So let's contrast that with somewhere in the Midwest, which is where cash flow tends to work better. So let's say I'm in a market and a property is $150,000. Well, then I want the market rents for that property to be about $1,500, which is a lot more doable. And as you get into a multifamily, the more units there are, the easier it is to make that happen. So let's just show the example of, let's say it was a duplex. And I know we're talking about larger multifamily, but I think it helps to make the point simpler to understand. Let's say you bought a duplex for $150,000. You need to have $1,500 a month rent coming in, right? In order to cover it. So that $1,500, if you have two different units, they only have to get $750 each. So if the market rents are $850 per unit, well, now you have $1,700 a month coming in for that $150,000 purchase. So not only have you met the 1% rule, you've exceeded it. So that's what you want to look for. You want to look for areas where the prices and the rents meet that 1% rule. And it's not that that is the end all be all when it comes to analyzing a deal. In fact, it's not even close. But what it does is it gives you an idea of whether that market is likely to be a cash flow market. Because the further you are away from that 1% rule, the more difficult it is to actually find a property where the numbers are going to work. All right, now let's talk about the thing that makes everyone like, oh, I'm so scared. Financing. Look, financing doesn't have to be something you're afraid of, but just know if it makes you nervous, it makes everybody nervous when they're new. So when it comes to financing apartment buildings, you're generally going to be looking at an LTV, a loan to value, of somewhere between 65 and 72%. Right? So loan to value, what that means is the amount that the bank is going to lend you compared to the purchase price. So for example, I'm going to use really even numbers so that I can do the math in my head. So let's say that we're buying an apartment building for $1 million. And let's say that the lender was willing to give you a 65% loan to value. That means the lender's going to loan you $650,000 towards that property. Well, that means you are going to need to have the difference, the down payment, which would be $350,000. Plus you're going to need impounds and closing costs and financing costs and reserves, right? So it does take some capital to make that happen. It doesn't have to be all of your capital. So don't let that stop you. For most people, when they get into real estate investing and they start scaling into apartment buildings, it's very rare that your money is going to go very far unless you just have tons of money laying around. All right, so we will talk about that later, but don't stress about it. If you don't have a ton of capital, it doesn't mean you can't do it. It just means we're going to teach you the way to fund that gap. All right, so let's talk about that lender piece, because the way I look at it, there's always two buckets of financing, the lender bucket and then the rest of the bucket. I'll call that investor funds. In the world of multifamily, you might hear people refer to that as debt financing and equity financing. All right, so when it comes to the debt financing part, conventional lenders, when they do their 65 to 72% loan to value, a lot of times people think, oh, I don't know if I make enough money at my job to qualify. Look, when you get into apartment investing, that stops being a factor. They don't care about your job and how much you make at your job and your income, because it's an apartment building. It's very unlikely you make so much money that you're going to cover the mortgage on a 20-unit building from your job. So it's almost like your job and how much you make becomes irrelevant. Well, then what is relevant and what are they looking for? So generally speaking, the primary thing that the bank is looking for is the performance of the property itself. So the way that the bank is looking at it is they're looking at it as if you're buying a business. So the bank is going to want to see, how does the business perform? Because it doesn't matter how much you make. It's not up to you. It's up to the business itself, the property. So if that property isn't bringing in very much and has lots of expenses, that bank is going to be like, yeah, I don't think so. That makes them very nervous, right? That's for a conventional loan. And that is when you're buying something that's already stabilized. So the other thing that the bank is going to look at is they are going to look at you, but they're not looking at you from an income standpoint. What they want to see is they're going to probably pull your credit. They're going to do a background check. They want to see whether you as a person are credit worthy, are responsible for taking on the responsibility of this property. So they'll look at your credit. Now, do they have a certain credit score? Every bank is different. So when you're doing your research up front, those are some of the questions you want to ask, because not everybody has perfect credit, and that's just the reality of life. What you want to do is you want to find a lender that is going to be ideal for whatever your situation is. So if you have some, credit dings from a long time ago, it's impacting your score, you want to find out what are they looking at so you can best align yourself with the lender that has the highest chance of saying yes to you. And even if something happened, you have terrible credit because XYZ happened, life happens. It doesn't have to mean that your investing career is over. What it means is you bring on a partner who has the credit that the bank wants to see. Okay, so they're basing it on the net operating income of the building. They're basing it to a lesser degree on you. Well, what exactly are they looking at and what does that process look like? So if you think about from the lender's standpoint, they're concerned about making sure that this building never goes into default. So they are looking very hard at the performance of the property, but how do they do that exactly? So while you're doing your own due diligence on the property, the bank is also doing their due diligence. So they're going to want to see things like a T12, which is a trailing 12-month financial statement. So it shows like January, February, March, all the way through December of how much rent came in, what were the expenses, and is it consistent? So if they looked in January and saw lawn mowing in Ohio, they might be like, something doesn't look right there. Whereas they saw snow removal in July, same thing, like something doesn't look right. So they're going to look deeply into the financials that you give them that are historical, so based on what the seller gives you, and they're going to make sure that this property performs in a way that makes them comfortable. Now, what if it doesn't? What if they're like, we're really not comfortable, lending our full 72% because XYZ. There's something about the financials they don't like. What happens? Does the whole deal fall apart? Not usually. So what is the bank trying to do? They're trying to mitigate their risk. They want to lessen the risk of making the loan. So sometimes they might say, well, I know we told you 72%, but based on our due diligence, we're just not comfortable. We'll still make the loan, but we're only going to make it 63% loan to value. So it doesn't mean that the deal is dead. They just might require that they loan less, which means you're putting up more money. What you have to do is you have to look at, if you're putting up that much more money or you're bringing on another partner because now you need more capital, do the returns still make sense? Sometimes yes, sometimes no. But the greatest thing is you can always use your due diligence or the bank's due diligence to go back to the seller and say, look, I'm interested in the property and I know we agreed on this price, but you also represented that your financials looked XYZ, looked a certain way. And now that we're diving into them, that's not exactly true. And because of that, I can't get a loan for as much. So we need to talk about how we can make this work. Most commonly, that negotiation ends up creating a reduction in the price, but it could be other things as well. It could be that they give you a credit at close. Like one of the students in our academy recently got both. The other thing that's possible, we've done this a couple of times, is when the bank isn't willing to put up as much as you thought, and it's basically going to kill the deal otherwise, and the seller is just like, they're standing firm on what their price is. But if they would be willing to carry maybe a seller second, that's another possibility. All right, now let's talk about something you're probably going to hear when you start making calls. There's this term called recourse and also non-recourse. Recourse is the most common kind of loan you're going to see. And what that means is if for some reason the borrower defaults on the loan, the bank is obviously going to take the property back, right? That's the typical foreclosure. But if it's a recourse loan, and let's say they bring the property back, they go sell it, and it doesn't cover what was owed, they can come back to the borrower and basically say, you owe us whatever the difference is. Okay, that's recourse, most common kind of loan that you'll see out there. If you own a personal residence, that's the kind of loan that you have. There's also something called non-recourse. You don't see it as frequently until you start getting into larger apartment buildings. But I want you to be aware of it because you never know. You might as well ask the banks as you're talking to them if they do offer that. So non-recourse means that when you go to get that loan, if for some reason something happened and the borrower defaults on the loan, the only recourse they have is just to take the property back. So as you get into larger and larger properties, that becomes more and more compelling because, if something happened and you were short $1 million, you're not just gonna be like, oh, no problem, here's $1 million. If it was you're short by 5,000, that's a different story. So when you start getting into, 30, 40, 50, 100 units, that's when you're going to start seeing recourse and non-recourse becoming a little bit more relevant. Now, I've dealt with local banks before that had both options. So let's say I was just buying a little 10-unit building. They might have recourse and non-recourse loans available. So what's the difference? Well, usually the difference is if you want non-recourse, you're going to pay more for it, which means you're going to pay a higher interest rate because the bank is deciding and choosing to take on more risk. If they're going to accept more risk, they're going to want more reward to go along with it. Okay, now let's talk about qualifying for a loan. Here's the deal. An apartment, it's not like that. You're not qualifying for a loan. So if you're ever talking to an agent or a broker and they say, oh, send me your pre-qualification letter, that is not a thing in apartments. So if someone says that, all it means is that they are inexperienced in dealing with commercial. So there's no pre-qualification because it isn't based on you or your income. So the closest thing you're going to get would be like a letter of interest. So let's say that you have a property that you're looking at, you want to make an offer, and you have a relationship with a bank, which we'll talk a little bit more about that in a minute. You can call your banker and say, hey, I'm looking at this property. Here's some of the numbers. Is this something you would loan on? And they might say, yeah, we would take a look at that. That sounds like it's within our lendability. Then you'd ask them to give you a letter of interest. So it's kind of silly that it even exists because it's not like it's any kind of commitment from the bank. They're just saying, yeah, we're interested in potentially loading on this property, but they haven't seen any financials. They haven't seen anything yet. So it's almost like a formality that sometimes is required to get the seller to feel comfortable, but in reality is fairly meaningless. But that's what you'll see. So if someone says, I need a pre-qualification, do not freak out because that's not even a thing. You can't get a pre-qualification when it comes to commercial financing. All right, so let's get back to building the relationship with lenders. Now, when you're brand new, this is an area that it's challenging. And I'm just gonna tell you straight up because I really wish someone would have told me that. It's not insurmountable. It's just that you have to take the reps that all of the other investors before you have taken, and that's okay. It's okay to be new. It's okay to take those steps. What you're looking to do when you're building a relationship with lenders is, first of all, show up professionally. So when you're communicating with them, let's say you're sending them an email, be professional, be courteous, and get to the point, and make sure your grammar is all correct, right? So you're building relationships with people who are considering whether you're going to be a good person to lend to, and do you have what it takes to run a property? So you're going to build relationships with as many lenders as possible. The best way to do it is do what you say you're going to do, when you say you're going to do it, be consistent, be professional, and make sure, even if you get into a deal and you found like your lender that's your go-to lender for that deal, always make sure you have a couple of backups. Always have at least 2 backup lenders that you have brought the deal to that they've looked at and said, yeah, we'd be interested in that. All right, now let's talk about building your power team. So remember when I said earlier in the video that you have the ability to do this business from anywhere. You don't have to live there. Well, one of the ways we do that is by assembling a team of professionals that are boots on the ground, experts in that market. Even if you are investing at home, I guarantee the people on your power team are going to be way more knowledgeable about everything related to their expertise in your market. So no matter what, whether you're investing at home or you're investing somewhere else, you're going to have a team of professionals. So that's going to be like a commercial real estate broker. You're going to have obviously the lender. You're going to have an inspector, building inspector. You're going to have third-party property management. You're going to have a title company. You're going to have insurance, right? There's all these people that you have to wrangle together to bring the deal to fruition. And it's funny because sometimes when you're new in real estate, you think, well, I mean, why wouldn't they just buy the apartment buildings? I'm not even in the area. They're going to get the deals before me. I know that makes sense in your head logically, but when you get into real estate and you start working, you're going to find that the building inspector, that's what they want to do. They want to inspect buildings. That's how they earn their living. They're not trying to buy buildings. It's a really different mindset. Same with the brokers, same with the property managers. Now they might do some real estate investing themselves, but sometimes they don't. And that's okay. You have to start to look at yourself as the CEO of your company. You're not paid to be a real estate investor. What you're paid for is 2 things. 1, to be a highly paid problem solver, and 2, to be a highly paid project manager. So your goal is to see the whole vision and know who exactly needs to do what to pull it all together, which is why your education in this is extremely important so that you know how to pull it all off. Oh, I know there's probably all sorts more things you want to learn, and you can find lots of them on YouTube. But here's the thing. If you want to go watch some amazing masterclasses that we've made completely free to you, all about apartment investing, you can go to our website, warriorsofwealth.com, and you put in your information, and it's going to bring you to a page that has 8 of our best masterclasses. So you can start feeling confident, so you can start taking one step at a time towards getting your first apartment building. All right, so I put the link to that warriorsofwealth.com in the description below. So now the most common question I get is, well, I mean, if I'm in California and I'm buying properties in Kentucky, how am I supposed to find a contractor in Kentucky if I'm in California? Okay, so you might be finding contractors if the property needs rehab, but really this goes for any team member. But let me give you an example that just kind of cracks me up, because over time that's been the biggest question people ask about remote investing. How am I going to find XYZ? So let's say that we're standing here right now, and all of a sudden I'm sitting here and I'm talking to you, we're on YouTube, we're having a great time, and all of a sudden what's happening right now? Man, I have a leak in my roof and it's dropping on my face during my YouTube video. Now what do we do? Well, what are you going to do? Am I going to go walk out of my office? I'm going to open up my door, stand on my porch, and then reach out and look down the street, up and down, and start screaming, I need a roofer! I need a roofer! Right? Because if I'm going to invest locally, that's how I'm going to find my roofer. I'm just going to put my head out the door and start screaming up and down the street, right? It's absurd. Of course you're not going to do that. What are you going to do? The same thing I'm going to do. I'm going to pop my laptop. Either way, we're going to pull up that World Wide Web, and we're going to start looking for whatever we need. So if I need a roofer, I'm going to Google, I need roofers in wherever I live, or I need roofers in Kentucky, in whatever city. Maybe it's Lexington, or maybe it's Cincinnati, Ohio, maybe it's Indianapolis. Wherever it is, I'm going to Google, I need X team member in that market. Now, when it comes to certain team members like contractors, there's actually tons of websites out there. Like there's Angie's List and Home Advisor and House, and there's all these websites that are specific for that type of person. So if you're looking for a general contractor in Lexington, Kentucky, you could go to any one of those websites and put general contractor in the city, and all the general contractors that are signed up to be on their website will come up. So don't be stuck by thinking, oh, well, because the property's out there, how am I going to find XYZ? The same way that you would find it when you're at home and you need something for your personal residence. You're going to open up your computer and you're going to look for someone. Then you're going to get on the phone and you're going to interview them, and you're going to make sure they have all the credentials they need. And you're probably going to interview at least 3 to make sure you're picking the right one. The same thing goes for when you're investing in apartment buildings, no matter where they're located. Next, let's talk about how do we find properties. So once you've identified a market and you've built a team, like how exactly do you get deal flow coming in? Here's the thing. There are so many ways that you can find deals. You can go fly to the market and go driving around looking for apartment buildings. You could send letters. I don't recommend doing either of those things. 1, time consuming, 2, expensive. So let me tell you the way that I've been teaching my students, because it's the way that I've been doing it for years and years and years, that will be the most efficient way to get it done and start getting you deal flow coming in. And it really comes down to one word, and that is relationships. Well, relationships with who? Well, when you're talking about apartment buildings, you're looking for commercial brokers. Why? Like, why commercial brokers specifically? In the world of apartments, it's a little bit different than residential. Well, when you're looking for a commercial broker, the way that it works is when someone's going to list their property or their apartment building, they're going to find a broker. Maybe it's somebody that sold them the property originally. Maybe it's just, ABC brokerage. Either way, they're going to list with that broker. That broker, before they go put it on the equivalent of the multiple listing, service, they're going to first go to their list of investors, and they're going to start calling all of their investors who they think might be a fit for this property, which means it's a non-listed property for a period of time. So even if you wanted that building, you would have no idea it's for sale because it's not listed anywhere. So how would you get the opportunity to buy that building? Well, by having a relationship with that commercial broker. So the idea is if you pick 2 or 3 markets that you're like, okay, all 3 of these markets are great. And I'm telling you, there's lots and lots and lots and lots of cash flow markets in the United States. So you are not limited. But let's say you've narrowed it down to a couple where you want to start, see if you can get some traction. So you're looking to build relationships with as many commercial brokers in the area as possible. And sometimes people say, oh, but if I buy something with this person, won't this one get mad? It doesn't work like that. because every commercial broker is going to have their own relationships and their own list of off-market properties. That is the whole idea, is the more relationships you have with brokers, the more access you're going to have to off-market deals. And you're going to have more people contacting you saying, hey, I have a deal before we list it, wanted to see if you're interested. Okay, now the next question naturally is, well, now where do I find these commercial brokers? So, I mean, same thing, you can, yell up and down your street, or you could do something far more efficient. There's a couple of websites out there. One is LoopNet, so it's LOOPNET.com, and the other is CREXI, CREXI. And CREXI and LoopNet are both places where they list properties. They list all kinds of properties, every kind of commercial. They'll have like mobile home parks and RV parks and apartment buildings and office and retail and student housing, like everything. So what you're looking for is you're going to go to that website and you're going to narrow it down to just multifamily. And you're going to look at those listings. Now, is that deal flow? Potentially. But by the time it gets there, those deals are not usually good because the brokers already tried to give it to their list, offer to their list, and no one took it. So it's not that you're going to those websites to find deals. Though, when you're new and you're trying to get familiar with what's out there, there's nothing wrong with taking a look there. But here's where the real gold is. Should I tell you? It's kind of a secret. All right, so what you're going to do is you're going to go find some properties that are in the markets you're interested in, that are the size you're interested in, right? Don't go look at a 100-unit building when you're brand new, because you're not going to be able to take it down. So start where you want to start. Maybe it's a 6-unit, maybe it's like a 10-unit, whatever it is. Go narrow the search to that and look to see what listings are there. Click on the listing and then go see who listed the property. All right, so let's talk about something that is really, really important, and that is called due diligence. So what the heck is due diligence? Due diligence is when you're going to take a minute, like you have a property under contract, you're going to take a period of time that you and the seller have already agreed to, and you're going to basically find out everything you can about that property so that you know whether you want to move forward with the deal. All right, now there's a common mistake that almost every new investor is going to make if they don't see this video or they're not in our academy being taught this, and that is doing the due diligence out of order. So let me explain what that means, because this one thing, I know we have saved our students clear 7 figures on this one tiny little piece of advice. So listen up. There's 2 types of due diligence. There's financial due diligence and there's physical due diligence. The financial due diligence is when you're discovering everything that's related to what drives the revenue and what drives the expenses. Okay, like the operating revenue and expenses. So we're looking at things like the financial statements, the T12, remember the trailing 12-month financial statement? We are looking at leases. Why are we looking at leases? Because we want to verify when they say it brings in this much money in rental income, we want to verify that that is actually true, that there is solid paperwork behind what they're claiming. It's almost like an audit. Due diligence and audit are very, very similar. All right, so the financial due diligence is looking into things like, well, what is the property taxes going to be? Because look, even if the seller says, look, here's our property tax bill, you know exactly what it's going to be. That doesn't mean anything for you. The thing is, property taxes are different in every single market in the United States, how they're calculated, when they're reassessed. But one thing I have found over the years to be super, super common is that when a property is sold and it's sold for a substantially higher amount than it was sold for last time, it is very common for the taxes to go up. Now, here's what you need to do in order to find out what they're going to be. Because when you're reviewing a deal, it's called underwriting, by the way. So like you're analyzing a deal, you're underwriting it. You need to underwrite the deal for what the expenses are going to be for you. So for example, if the seller had a property tax bill that was $20,000 a year and he's owned the property for 10, 12 years, when you do your research and you call and you talk to the powers that be in that local municipality and you find out, chances are once you close on the property on this new amount, that it's going to pop the property taxes up to $32,000 a year. Well, that's a $12,000 change in your net operating income. That's going to have a massive impact on the value of the property. All right. The other kind of due diligence is physical due diligence. And I know I told you that the whole big mistake people make is doing it out of order, and I'm going to get there. So hang on. The physical due diligence is when you physically have someone going to the property and looking at what's wrong with it. So who on our power team are we going to get to do that? It's going to be the building inspector, You're gonna have the building inspector look at everything. And they should know this. It's not like you have to explain it, but do verify. You're looking at like the structure. You're looking at all the major mechanicals. You wanna make sure that the roof, like these are all really big expenses. Not only that, you want them in every single unit. What's wrong with the unit? Is there anything? Is it that, there's a leaky faucet that's gone onto the floor and now it's got mold on the roof of the person below it? Like, it could be a lot of different things. And I don't tell you that to scare you. I tell you that to empower you to remember, don't ever skip even a single unit with inspection. Because here's the thing, it's not like it's gonna kill the deal. I mean, it might, and if it does, that's a gift for your future. But more realistically, what it's gonna do is give you negotiating power to go back and say to the seller, look, the way that you presented this building was this way. However, when we've done all of our research, this is actually what we found. So we need to come up with something that's gonna make this right. And usually that's where the price reduction or the credit ends up coming in. All right, so you have your physical due diligence. And also when you're buying an apartment building, you're probably gonna have your property manager that you're gonna hire go with the inspector unit by unit, because you also want your property manager to be intimately familiar with the building, with the flow, just, meeting the tenants that are there. Okay, so what's the big mistake that people make when it comes to the order of due diligence? It's doing it in the wrong order. What do you think that means? What would be the right order? Now, financial due diligence is free. I mean, it costs your time, right? But you're not shelling out money for it. Physical due diligence, that's a whole different game, right? You're hiring a building inspector, and the larger and larger the property becomes, the more expensive that becomes. So let's just say, for example, you do your physical due diligence first and you spend $2,000 or $5,000 or $10,000, depending on the size of the property, for a building inspector. You get all the information back and you're like, okay, physically it looks good. And then you do your financial due diligence. And you realize, wow, the seller really misrepresented the rents. I'm looking at the leases and the leases are not matching the rent roll at all. So basically the seller misrepresented the property. Or let's say you find out that your property taxes are gonna go up by $50,000 a year. And I know I'm being extreme with the numbers, but it's just really to help you understand the concept. If your financial numbers end up making that this deal is not gonna fly, wouldn't you wanna know that before you go drop several $1,000s on your inspection? Yes. And frankly, until you've done that 1 or 2 times on your own and you start making the connection, like this is actually very expensive, because that money, it's a sunk cost. You can't get it back. That's the biggest thing that a new investor is going to make a mistake on if they don't know this one thing. So always do your financial due diligence first, and then do your physical due diligence. Because if the financial due diligence looks fine, you do your physical due diligence, and let's say it's not fine, then you go back and you renegotiate the deal. All right, next let's talk about how do you actually make an offer and how do you close a deal. So when it comes to apartment buildings, you can certainly make an offer on a purchase and sale agreement, though usually in apartment world, that's not usually where we start. There's something called a letter of intent. You might hear people say LOI. LOI stands for letter of intent. A letter of intent is a non-binding agreement. So it's usually short, maybe 1 or 2 pages. And the way I liken it is it's almost like a love letter. You're like, hey, do you like me? Yes or no, right? So what it's like is you have this 1 or 2 page document and you say, here's the property, here's the price I'm interested in paying, here are the terms. Let's say I want 30 days for due diligence, a 60-day closing. So you put the basic things that you're asking for, and you take your love letter and you give it to your broker, and your broker gives it to the seller's broker, unless it happens to be the same one. And the seller's broker gives it to the seller, and the seller says, do I like you, yes or no? I'm still thinking about it, but I'm gonna say no, but I would like you better if you offered this much. So the letter of intent is like this informal way of just negotiating the deal before you start getting into a 10, 20, 30 page contract. And it just helps to save time. So when you get into doing apartments, more likely you're going to start with a letter of intent. And the thing is, as a new investor, that's actually much better for you because it takes off the stress. Because no matter what, when you're buying your first apartment building, you're going to be freaking out. You're like, oh my God, this is so scary. Everybody feels like that, and it's okay. But if you're going back and forth on a document, and even if the seller is like, I like everything about that, sign on the dotted line, it's still not binding, right? So it allows you to take a breath, take it one step at a time. But what happens is when the buyer and the seller come to an agreement on the letter of intent, and sometimes I am serious when I say this, it could be as much as scratching things out and then scanning it, emailing it. They print it, scratch a couple things out, write in some other things, initial, send it back and forth. Like it can literally be like a love note going back and forth in 7th grade. All right, so when to agree to what the terms are going to be, then the brokers put all of the terms onto a purchase and sale agreement. From that point, it's common for it to be another week, sometimes 2 weeks of negotiating like the fine details. But can you imagine negotiating back and forth on a 30-page document back and forth? Ugh, like nothing would ever happen. So that's where the letter of intent comes in. Okay, now the question is like, how do you know how much to offer? Just know this, when it comes time to make an offer, you're making the offer that works for you. Does it mean you're gonna get a yes every time? No, it's quite the opposite. You'll mostly get no, 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 no. That's fine, because the last thing you wanna do is buy a property that ends up not being a good deal. Because once you buy it, it's yours. You're kind of stuck with it, right? Unless you bought it for such a good deal that you can sell it to someone else, but that's not what we're talking about, right? So every time you make an offer, it's gonna be at a price that works for you, and we will teach you in a later video how you can determine what is the right price for you. Once due diligence is done and you're heading to closing, like what are some of the things you need to be looking at? Now, I am not kidding when I tell you that going to closing, and this is really every level of real estate, when you're heading to closing, it is literally like taking a lasso and trying to herd cats. You are herding cats. You're a professional cat herder when it comes time to close a property, because you are literally balancing everyone. You're talking to the broker, you're trying to get the broker to have the seller's broker send X or Y, and you're talking to the building inspector. Did we get this yet? Did we get this credit? Talking to the title company, you're talking to the lender, talking to the property manager, and you're trying to get everything together. So when I say you're a highly paid project manager, that is no joke. That's exactly what you're doing. You're highly paid cat herder, project manager, pulling all the things together. I promise you this, there'll be somebody somewhere on your team that is not doing what they need to be doing, and you're gonna have to like get them to get into action. That's your job. That's why you get paid. All right, so what happens is you're herding all the cats. So you're making sure the lender has what the loan's gonna be. They're getting the loan documents to the title company. You're making sure all of like your money. So if you're bringing in JV partners, that the money partners have sent in the funds. If you're doing a syndication, that you're making sure like all the paperwork is done, all the money is funded. You're looking at the title company paperwork. So you're looking at the title commitment to make sure everything looks good. You're looking at the settlement statement, which I've never seen one that's right the first time. So just be aware of that. It's probably, when you're looking at it the first time, it's probably wrong. So make sure you're looking line by line and that everything looks right. But that's what you're doing. You're looking at all the documentation to make sure everything is good, because once you sign, once the deal is funded, you can't change anything at that point, right? So that's what it takes to close a deal. Now, when you've actually closed, nobody told me this, so I'll tell you this. It feels a little anticlimactic, because frankly, you're not like when you're buying your personal residence, you're all excited and you're going to the closing table at the title company and you're signing documents. Well, we invest remotely, so we're not going there to sign anything. A lot of times you'll sign everything and then you're just waiting because the lender hasn't sent their wire in yet, or one of the partners they have like Chase Bank, and Chase Bank is requiring an extra verification on their wire. Like there's all these different delays. So you've done everything you can do and you're just like, okay, you're waiting. And all of a sudden you get an email from title, okay, you're closed. And you're like, oh, okay, all right, cool, like you closed, right? So sometimes it can feel a little like, So you gotta make sure that you and all your partners and all your investor friends, that you celebrate, because the act itself is not as exciting as it feels like it should be. It's just like, okay, you closed, okay, right? So like get on Zoom with your partners, get on Facebook, tell everybody what happened, and let people celebrate with you, because that's where you're gonna get like the charge and the excitement from. I just realized like I didn't know that when I was new. So I was just like, yeah, like, okay, oh, that's it? That's all there is? And we still feel that way to this day. So we gotta come up with things that make it exciting. All right, so when closing happens, what happens next? What is post-closing look like? Well, frankly, when you're in the world of apartments, it's not like you're gonna wait to close before you have your property manager selected and involved. When you're gonna do an apartment building, just even the takeover of that apartment building has to be done very systematically and very professionally to make sure that the tenants who live there don't freak out because there's a change and then move out. That is one of the worst things that can happen. So you need to make sure that far in advance, you're talking to your property management company that you guys have outlined a plan for, like, the day we close, these are the things that's going to happen, because you want the transition to be easy and smooth from the standpoint of the tenants. Because ultimately, unless you are trying to get rid of the tenants, which that's not usually the case, maybe a couple of bad seeds if you have them, but you want the tenants to stay because that's what's producing the revenue of the business. All right, so post-closing isn't about you going to find a property manager. It's just more like, okay, we already set what the plan is even before closing. Now it's time to execute the plan. Now, one of the things that I feel is a huge misnomer in our industry is the word passive income. Like, when you're the ones doing this kind of investing, it is for passive income, right? We're not going to a desk and clocking 8 hours a day in order to get that rental income, right? From that standpoint, it is passive. However, when I was a new investor 20 plus years ago, I thought passive investing was like literally you buy it and then that's it, you're done. But that is not the case, right? Nobody cares about your business or your assets more than you. They never will. You're the one that cares the most. So the most important thing that you can do to have success in this business when it comes to rental property is making sure that your third-party property manager knows that you are looking and you're paying attention. So when you're buying an apartment building, especially if there are value add activities to be done, you're probably going to be meeting with your property manager every week. You are the one that needs to set the cadence. So you don't want to go a whole month before finding out, oh, what did they do? If it's already stabilized, there's really nothing to be done. Once a month might be appropriate. At least after the first 4 weeks. You want to meet once a week in the beginning to make sure everything's going smooth. But if you're doing a value add, that might take 6 months to a year. You're probably meeting with your property manager over Zoom or over the phone once a week. And what you're doing is you're making sure that the business plan that you and the property manager created together to put this property where it needs to be is being followed. Because, sometimes they're managing multiple properties and they might have done, 4 of the things that were on the list, but there were 6 things. And maybe the other 2 just kind of fell off their radar. That's where the highly paid project manager comes into play. So you're meeting with the property manager to make sure things are moving forward. You're looking at your reports every month in detail to make sure everything is going the way it's supposed to. So if you start seeing that there are expenses there that was not part of your underwriting and you don't know what it is, you need to ask questions. Because unfortunately, every once in a while, you're going to end up with a property manager who either one, just accidentally codes the expense of the wrong property, which that doesn't help you, or 2, just to sees what they can get away with. What kind of expenses can they pass through that maybe benefits them? That's an unfortunate part of it, but the way that you can avoid that is by looking at your reports and asking lots of questions. Because the client that the property manager is not going to try to do that with is the one who's constantly looking. It's really easy if no one ever questions the reports. They can put all sorts of expenses through because no one's ever looking. But if you're the one looking, and you need to be, you're not going to be the one that falls victim to that. All right, now that you know how to buy your first apartment building, let's help you understand how to find the right property, how to manage it, and what major pitfalls to avoid. I made a whole series of videos that go deeper into each one of those steps. So click the video that's on the screen right now, and I'll see you there.